Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to a really special episode of Carson's Facts versus Feelings. Ryan and Sonu here. Sonu, we're really excited to be joined by Mr. Warren Pies. We'll get into all the stuff, but here's the title. We really worked hard on this title. Talking Pies, Pie Day, Patty's Day with Warren Pies. And Warren, we're dressed like fools. At least I am. You've got a little green on too. What do you do for?
I've got
Oh, look at Sonu. There it is. Now he's come to play. What do you do for St. Patty's Day, Warren? Do you do anything crazy?
No, I don't have any crazy. I mean, this is about as crazy as it gets, a green sweater,
Okay.
Yeah, you guys had me afraid that I was going to get pinched or something, so I had to put it on.
We didn't tell you there's someone in your apartment behind, or your house behind you, going to pinch you that we sent from the team. No, but Warren, give us your title, because we do like titles around here, but also what you do all day to help investors. And we're going to have a lot of fun talking about the latest in the world.
Yeah, I'm the co-founder of 314 Research. We're an independent research shop. We basically do data-driven, macro quantitative research for mostly institutional clients. I'm also now the portfolio manager for two ETFs. The first is the full cycle trend ETF, and the second is our real asset allocation ETF. And so both of those, the RAA ETF started trading last week. I guess it'll be 2 weeks once this airs.
Wow.
And the
RAA, right? Congratulations.
RAA. Yep. Thank you. Yeah. And so I have branched out into asset management, I guess, at this stage. So it's just, but the research drives everything. I'm a researcher at heart, and that's really what that's the straw that stirs the drink for us.
Sounds like you're a glutton for punishment, because we do the same thing, research and managing money. And sometimes that can be kind of difficult. I'll just say this much. A little about me real fast, Warren, then we're getting with you. I'm in Arizona today. I flew out yesterday. We're recording this actually on Friday. What's today's date, guys? Friday the 7th. Doing a little early because Sonu and I are
10
traveling
days
next week.
before St. Patty's Day.
Yes, yeah, it was a good deal before St. Patty's Day, but this is technically our podcast before St. Patty's Day. So maybe get some green out there. We'll talk about that. But I came out for a client event. Shout out to Jake. Great client event last night. Brought my boys because, okay, we're Reds fans, right? Cincinnati Reds. The Reds play today, Friday. I said, this will be great. It is raining like crazy. It's 48 degrees. This is the coldest day all year, and it's like one of the 6 days a year they actually get rain in Phoenix. So I don't know about market timing, but I did not time spring training well. Crossing my fingers in 4 hours it changes, but it is what it is. Warren, you have a favorite baseball team? What sport? I mean, you look like a bodybuilder. That's the joke. You're cut. What sports do you like?
I mean, I'm more of like a football and baseball, not so much. I mean, I'll go to a Rays game every once in a while down here in my neck of the woods. But yeah, more of a football guy, Bucks fan. My dad was from Green Bay, Wisconsin, so Packers fans, stuff
important.
like that. So yeah, and Florida football is kind of a big deal down here. So
I'm still learning the difference between AFC and NFC, and if I got that right. But
Sonu just learned that the Chiefs are in the AFC about a month ago, so we're trying. We're trying, Warren. We're trying. I'm not kidding. He's the smartest guy I know, but he doesn't know the Chiefs are in the AFC.
But, like my season starts now. I mean, next week Formula One starts. A bit of ads. That's why I got into engineering, and that's I'm pumped about that.
Yeah. So let's get started. I mean, I think the thing that just happened, the jobs number. I know, Sonu, you love looking at the data. Warren, you look at the data. Believe me, I haven't paid much attention. I saw missed by a tad. But Warren, I just want your initial thoughts on that monthly jobs number that came in a little bit weaker than expected.
Yeah, so what we like to look at, I think you have to have a view of how we're in this growth scare period of the market right now. This is something we thought we would go through here in late Q1, early Q2. This was like the way to detailed prediction when we entered the year. So I think everyone's looking now at the data. We came into the year, it was like higher for longer, the economy was fine, and all that was kind of taken for granted.
You're
Now,
going to get 3% GDP growth and things like that.
yeah, everything just, trees would just grow to the sky. And now I think that's in the sentiment around the economy is funny. It swings so wildly. So I think that the prism that we were all looking at this number here was, is there a sign of like a real crack in the economy? And the bottom line from this report is no, I don't see a crack. And my view is, it's not that there's no risk of a recession, but I don't see anything in the data that would allow me to call for a recession at this point in time. Obviously, things can happen. And one of when you pick out a few data points, like the one that we really focus on, you want to find a leading indicator for the economy. Our view is that recessions start with these cyclical interest rates areas of the economy. So we look at residential construction payrolls carefully. Residential construction payrolls still at cycle highs. So that our rule of thumb, just for everybody, is that those usually decline by 8 to 10% before you get into an official NBER recession. So it's that which is an important indicator for us, is not rolling over yet.
It's funny when we decided we were like, oh, we should get Warren Pies on, and always trying to see, okay, let's get people on who we may not completely agree with. And then I was like, oh my God, finding it hard to disagree with Warren on anything.
Oh, no.
In a good way. But no, construction payrolls, right? Growing close to maybe 2% year over year, something like that. It's not as much as 3% a year, year over year, like it was, maybe 12 months ago, 24 months ago, but still solid. And that's something we look at as well. And, when I was looking at the data, I was like, there's nothing in here that tells you the economy is breaking, but there's no cyclical acceleration either. Right. And that, I think, gets to something you've been pointing out, that, expectations are way too high. And especially as related to interest rates, which is what I found fascinating about your, I think, 2025 outlook, the search for neutral. Without getting too geeky about what neutral is, it's essentially where the Fed thinks they'll end up in terms of, their terminal rate, right? In this expansion cycle, just for everyone listening, it's essentially what we think, okay, where will the Fed end up? Where will interest rates be, right? That neutral point, without getting too geeky about it. But explain that whole concept, that search for neutral, because it ties into, this over-optimistic expectation, higher for longer, all of that. And I think we've been on the same page with respect to it. This is a little stretch too far.
Yeah, absolutely. Sure. That we said the theme for 2025 would be the discovery of neutral. And then, like you said, neutral is just that interest rate where the Fed's going to probably, and I would, for the economists who want to be pedantic, like call it cyclical neutral or terminal rate. Like, where is this cutting cycle going to end ultimately, where we would balance inflation risks and growth risks perfectly? You never know. And there's so many different ways to cut the neutral concept down, because you never really know it in advance, and you don't even really know it when you're there. But it's a great conversation facilitator, and that's how the Fed speaks. So we should speak their language a little bit. And so our view coming into the year was that that ultimately policy was restrictive, and the Fed was going to, and there was this idea that because the Fed cut in September and the longer term rates moved up, that basically the Fed didn't control the long end of the yield curve. And that was, we thought, a mistaken belief. And so our view is that the Fed was going to have to ultimately do more. If you analyze the bond market and the yield curve, the Fed was going to have to do more to get us out of this restrictive posture in the economy, and that it was going to become clear that rates were restrictive, that 7% mortgage rates were restrictive to the housing market.
It still is, right?
And it still is. Yeah, absolutely. And that's what you're pointing out in the housing report. And I think that's something that I think you see Treasury Secretary Scott Bessent coming out onto these programs. He's kind of hinting towards, there was a lot of government support over these last few years, and that as they do remove some of that government support, you're going to have some potentially, he's calling it a detox period. But there have been very restrained areas of the economy. We point out things like existing home sales at basically all-time lows, at going back to the GFC, the last time you see an existing home sales where we're at. Automobile sales back to 2018 levels. I mean, these are interest rate sensitive areas of the economy, and there's absolutely restriction when you look to them. And again, just like you said at the beginning, when you're talking about why do we look at residential construction payrolls, why am I so focused on the cyclical areas of the economy? Because if you're an investor, you want to stay invested unless you see a recession or Fed tightening. That's like your big picture framework. And in order to call for a recession, you have to have an idea of how they transpire. And in my view, there's cyclical areas that are restrained by policy that start to roll over first. And that's the story of every recession. Maybe we have a different one this time because the Fed cut or there's so many Doge cuts or something, but I don't want to make that bet. I think it's going to be, you'll see it first in these very cyclical areas. And we're not seeing that yet.
And you have to see it somewhere, right? It can't just come out of the blue suddenly. Like it will happen. Like we'll see it in the data, in all these leading indicators.
It's job loss. I mean, a recession, to the extent we want to care about it as investors, is it's ultimately job losses, and we're, it's been well documented. It's something we've talked about is that a lot of the job growth over this post-pandemic period has been government, education, and healthcare. So kind of non-cyclical areas. These are government spending adjacent areas of the economy. Those are, you're not going to wake up one day. Maybe I used to say this, but maybe with Doge it's going to change. But you're not going to wake up one day and have the government just cut all of these jobs, enough jobs to send us into a recession. One of the things one of the stats I bring up is that construction jobs are a tiny sliver of the overall economy. I think residential construction jobs in particular, residential construction jobs just in total are, I think 1%, a little bit 2% of total jobs in the country. And if you go back,
that, I'm literally looking at the data right now. Residential construction jobs like 955,000.
And I think there's another 900,000 non-residential
specialty trade contractors, things like that.
So if you go through your typical recession, though, they can account for up to like 30% of the jobs lost in a recession. So that's where the job losses come from. So that's what we study, and it's what we model out in our work.
So you mentioned the word Doge. Let's talk about that, because Sonu and I work with advisors, right? Over 500 financial advisors all around the world, all around the United States with Carson Group. And we talk to their clients, and obviously there's a lot of worry. Doge is just cutting all these important jobs, and there's all this uncertainty coming. The challenge, I know Sonu's got some thoughts on this. The Challenger Gray and Christmas layoffs jumped up to expected layoffs, I should say. They jumped up to 172,000, highest since June of 2020. Up 103% from a year ago, 50,000 just last month. 17 different agencies in the government announced cuts, totaling 62,000. I don't know where I want to take this question exactly, but how worried are you? We did see a big spike in that particular survey, but also, the government cuts that are coming, because I'm telling you, our clients, or I should be more specific, our advisors' clients are very worried about what's going on there. What's your take there?
Well, it's too bad you didn't get. I tried to send through the report from yesterday. I guess there was a problem with it. We had a great chart on that, and I'll post.
I'll tell you what, we'll share that on the YouTube channel right now. Yeah. Share that chart, Josh. Take this time down. We will share whatever you're talking about on the YouTube channel right now.
Yeah. Well, anyways, when you look at it, there is a huge spike, which is abnormal in government layoffs, but it's not just government layoffs. They're announced. It really goes across all these private sector industries as well. Mm-hmm. Retail was spiked up also in the survey. So as far as like what kind of impact Doge is going to have, I think there will be an impact. I think it's when you think one of the core reasons the economy was so resilient over these last few years is because we've been running a massive pro-cyclical fiscal deficit, 6-7% of GDP. It's one of the charts, again, that we show in our chart book almost every quarter. We can lay out all these things. There's some breadth deterioration in the job numbers. There's some, like we said, restraint into interest rate sensitive areas of the economy. Credit creation is not so great over these years, but at the end of the day, we've never seen the economy go into recession with this big of a deficit. And it's really difficult because that's pure money creation out into the economy. When you're spitting out, say, $1.8 to $2 trillion deficit, that's money going into the interest rates, into the pocketbooks of
that's new money, right?
It's jobs, it's everything else. So there is a real risk if Doge cuts enough that we're going to see that. And I think if that's been the ballast of the economy over these years, and Doge starts cutting, then the complacency around recession should probably be more, might be too much if that starts to happen now. the other side of that argument, I know we stay apolitical. It just is what it is. But the other side of that argument is that the deficit's probably been the source of a lot of inflation that we've seen. And so, and that's my view. I know there was like a debate for a while with, is it supply chains? I think it's pretty clear at this point in time that it was mostly on the demand side and it was mostly due to spending, and that can relate back to the deficit. So if we are to close the deficit a little bit, that should be good for inflation, should be good for interest rates, should be good for private sector area of the economy, these areas that have been depressed. So you should see credit creation take the baton from government spending in a perfect handoff. Now, there's always kind of turbulence in that process, but that's kind of where I think policymakers are trying to take us.
I want to come back to the Fed, but we'll say, just to stay on the topic of payrolls, labor market data. You mentioned something that job creation, especially over the last year, maybe year and a half, definitely 6 months, it's been driven by healthcare, social assistance, and government jobs. But the government, a lot of it has been state and local, right? And now my worry is, and it's like, I'm not saying there's a recession or anything like that, but a worry is we have the cyclical areas sort of depressed because of, say, high interest rates. And even though construction is doing okay for now, but what if we get, state and local governments slowing down? And this has, maybe less to do with DOGE and everything on the federal level, which gets all the headlines. But I'm worried about what if state and local governments start to pull back? And then you get, let's say, Medicaid cuts, and then that hits hospitals across the country. It probably hits actually state and local government funding too. And I'm curious how you think about that, if that makes sense.
Yeah, no, like I said, if I do think that there's a relationship, that's one of the rebuttals to the idea that to the DOGE initiative really is that, oh, look, there are roughly 3 million federal workers, and that number's been more or less unchanged for many years. So the federal government is small, but I think there are a lot of federal government spending adjacent areas of the
contractors and stuff
that are not being captured in those statistics. And so, yeah, contractors, NGOs, and state and local. I believe some state and local support is rolling off here at year 4 post-pandemic. I can't remember the exact amounts in titles, but yeah, that's bound to happen. That's bound to happen. Is that you will see that show up in state and local government payrolls, and I think there'll be some probably tough decisions that have to be made in certain jurisdictions and things like that. So yeah, that's part of the transition, and another reason to, when you take it back to markets and investing, that we came into the year. I mean, the percentage of forecasters expecting a recession had gone back down to crazy low levels. And I just think that it's all about what's priced in probabilities relative to what's priced in the market. And I just think that some of these, there is more of a risk of this growth scarcity into a true contraction than what's priced into the market.
Yeah, so we've done 120. This is our 126th episode of Facts versus Feelings, and let's say about 100 of them ago, so 2 years, would Sonu and I push back against a constant bearish narrative, and it wasn't popular, like you said. And then all of a sudden this year, I look around, it's like nobody's really expecting a recession. People are kind of feeling optimistic. It kind of worried me a little bit. But Sonu, what we're talking about St. Patty's Day for a second here. Don't you do something with green and St. Patty's Day? What happens in Chicago with you and St. Patty's Day?
And you and I always do a call, at least one of our smaller 5-minute videos.
Yes.
When Chicago turns the river green, which is kind of a euphemism.
And you're jumping in it this year, right? Didn't you say you're going to jump in this year?
The river's almost always green, but no, they dyed a bright green. This green, I'm wearing a bright green T-shirt right now. It's like it's amazing to see, and it's cool to watch. I'm taking my kids out to the river this next Sunday, not this coming Sunday. So the 15th, and it's cool to see the boats throwing, it's now, vegetable dye or something like that, so that it doesn't kill any fish that haven't already been killed by toxic waste in the river. So, but yeah, no, it's fun to see it. And Chicago looks kind of really cool to see the river and all these amazing buildings next to it with like bright green water in the middle.
Yeah. One of these days I need to get up there. I know, don't they start partying early, right? So in the afternoon, you never know what you're going to see. And again, we're titling this one Talking Pies, Pie Day, and Patty's Day with Warren Pies. I'm at a hotel. I got myself a little pie here. What's your favorite? I'm going to eat a little pie while we talk. What's your favorite pie, Warren? And Sonu as well.
Oh man!
Actually, I'm cheating. This is a cheesecake. It's all I could find at the hotel.
Well, Warren's
Just-
I think I mentioned this, but mine is chocolate pecan.
Oh, I'm chocolate.
Oh.
Yeah.
I mean, I think it's I'm kind of depends on the season of the year, but probably if I have some vanilla ice cream, probably an apple pie.
All right.
Yeah, I'm a
Is
chocolate
that a la
cake.
mode? Yeah.
Oh, a la mode. Yeah, I'm chocolate cake, but pie, I'm with you. Good old fashioned grandma style, old fashioned apple pie. Tough to top that one.
Speaking of pie as in PI.
There we
pie,
go. I have one more bite of my cheesecake. Then I'll listen.
So what was the origin? Tell us about the name 314.
You guys are really dancing around the whole concept. I guess we were trying to be clever.
Yeah.
My last name.
We're trying.
Pies.
We're trying.
Last name being pies, and then we like to think of ourselves.
It just worked out.
Yeah, as a
We spend more time on stupid stuff like that than we do anything else. We love it.
It's good. It's serendipitous for us. I get to explain this. That's what happens when a finance guy tries to be clever. You end up with a firm name like 314 and talking about what your favorite pie is at the same time on one of these podcasts. So
now, one thing I like about the stuff you put out, and you mentioned you're a portfolio manager now too. That's part of the title with the 2 ETFs that have come out, and is a lot of times on the street you see all the views, even from the big sell side teams, but even on the buy side, right? You have the economists doing their forecast and the strategists doing their thing. And then when you look at the portfolio managers, they're doing something totally different, right? Mm-hmm. What I appreciate about what you do, and I think I put us in this camp as well, the same people coming up with the views, coming up with the ideas and the narrative. And you could talk about, I think this is another thing about what you guys do. And even Neil Dutta over at Renmac, the narrative is important too, and understanding what the market's narrative is at the time, and seeing what the, what's the gap there, right? What's what can we possibly take advantage of? But talk about how you convert those views into actual portfolios, because at the end of the day, that's where rubber hits the road. That's what matters, right?
Yeah. So most of the two ETFs that I manage are based on models that we've run in real time for years for our clients. So everything's rules based and quantitative, and that's I think that's, to me, we've had discussions with people who want to do a discretionary type funds too, but our background is modeling and basically quant modeling. In my background, if you go back even farther, was in the energy space over at Ned Davis Research before I started this firm. And I know you guys have talked to some of my old colleagues there on the podcast. So you learn little lessons and then you try and code them into your models and stuff. And so one of the lessons I learned that was beat into my head covering energy is that the importance of quality. And so quality is the backbone of our equity selection strategy, the full cycle trend strategy.
Explain quality as well.
Well, our quality, again, one of the reasons I like it as a factor is that it's kind of undefined in a lot of the literature. And so you can put your own spin on it. We focus heavily on return on invested capital, balance sheets, basically not being too leveraged. And these were like principles I learned. It's like if you went through, when I was covering energy from like the 2010s into COVID, that 10-year stretch from 2010 to COVID, I mean, it was brutal if you bought anything that was low quality. And so it really attracted me to that as a factor. So we started building that into our overall equity selection. And what you realize is that investing is really about not making big mistakes. The upside kind of takes care of itself. Just don't make a big mistake. And in quality, I think, is like having that as your base to your model. It's such an important factor to keep you from making a mistake. And then what we did is we layered a bunch of really proprietary technical research on top of that quality factor. And one of the things we found within our equity selection is that if you have a quality universe, that you can more aggressively buy pullbacks. So what we like to do and it doesn't work in a non-quality universe. You buy a big pullback in a non-quality universe, a lot of times you're catching a falling knife. But if you're confident that what you have is a quality universe, you get an uptrend and a pullback, those are buying opportunities. And that's what we're doing in the fund constantly, is executing that quality uptrend, short-term pullback, buy it. We turn that fund over about 4 times a year. And I just think if you play that hand over and over and over in the years, you're just going to separate yourself from the index. It's really that simple in our view.
The energy thing is fantastic. I forgot that your background is energy, and I think about sometimes, I feel like in a way that's been the toughest market within equities. I mean, you said 2010s, but going back to 2007, 2008, we've had three massive bear markets for the energy sector, right? But on that topic, where are you now with energy? Because it's two sides of, the two sides of that coin, right? One is, energy prices going down. That's good for inflation, right? That's good for the Fed outlook. But the other side is, it's tougher for energy companies out there, right? So I'm curious where you are.
Yeah, haven't been very positive on oil price for quite a while. And
I would
so
say congrats there. You've obviously been very right.
Yeah.
Well, I appreciate that. Yeah. So, I mean, again, it's about not making mistakes. And so we run a model. I think that's, again, everything's model based. Our model's done very well for us, and that's kind of the backbone. But this period's been weird because you see inventories draining, and that's kind of the scorecard for supply and demand. If you go to the oil market, you see inventories draining, and you see the curve backwardated, which tells you that you're in this near-term deficit. And so you get a lot of analysts and kind of market watchers who haven't seen a lot of cycles come through, and they see that and they just say, oh, hey, this is bullish. These two things are ultimately bullish factors. But the big fly in the ointment this time has been the amount of oil OPEC has restrained. They've been supporting the market, OPEC, and we've been waiting for that oil to come back, thought it would be a really negative catalyst, and we got that this week. And so as it applies, I think it's tough for the domestic industry. I mean, the domestic energy industry has been in, like you said, the shale is not, it's been a blessing and a curse. And so the price volatility and the ability to plan and make investments has been tough. And I know Trump said he was going to lower the price of energy by drill, baby, drill. And I've always said that's just not going to happen. I mean, they need a price.
Yeah, that's like, you can't have it both ways, right? Either you have, they're not going to drill if they can't make money.
I think what he meant is drill, baby, drill for OPEC. And so you're going to see a lot of drilling in Saudi Arabia and UAE and places like that. But it's not going to be so good for the U.S. Industry going forward. I think it's great for the overall market backdrop. I look at energy at this point in time as kind of almost like a hedge to my portfolio. One of the big risks that can crop up is oil prices spike like they did in 2022. And so I treat energy in our asset allocation fund, and we treat energy as a kind of a hedge position, and it's singled out away from the rest of the equity exposure for that reason. And so, yeah.
See, I knew it would come back to us just agreeing, because we've had, managed futures with commodities and stuff in our portfolios. You're saying diversify your diversifiers, but it gets to like, people have been talking about stagflation, and I keep thinking you're not going to have stagflation with oil at $67 a barrel.
No way. There's no way to get stagflation without a serious supply disruption. I guess tariffs could potentially do it if, depending on how bad they are, because that is like a supply disruption. But to think that you can get stagflation without, and this was why the 1970s comparison was always just crazy to me, is like energy CPI increased by like 80% cumulatively during the second wave of inflation in the 1970s. And we had, I want to say 4 million barrels come off the market due to geopolitical crisis events back then. I mean, we have the exact opposite scenario this time around. We have 2 million barrels coming back onto the market due to OPEC's emergency cuts over these years. That's going to keep a lid on the price of oil. So I've never found that 1970s comparison to be convincing whatsoever on the inflation front.
Well, that's interesting. You mentioned so good earlier as an energy guy, I guess at heart to a degree. Did you get into Landman? Did you watch the show Landman with Billy Bob or no?
It's been recommended to me, but I've never watched it. No.
Okay. No, you'd love it, first off. But he made a comment, and I'm guessing this is right. I'm sure do the research about how the people that drill oil really want oil around $75 a barrel. Because if it's much higher, like you said, people can't afford it. If it's much lower, it probably means the economy's slow. So there's that perfect level right around there. And obviously we were there a few weeks ago, but obviously sold off. But definitely check out Landman. One other thing here. We've got like only 10 minutes to go. It's amazing how fast this goes. You mentioned Ned Davis and Ned Davis Research. We've had Ed on the show before. We've had Alejandro on the show before. Huge fans, obviously. What's a thing that you learned from Mr. Ned Davis? Because obviously he is just a titan in our industry and someone I've looked up to for years, read all the books and get to research. What's a little story about Ned that you can share with us?
Yeah, well, one of the cool things about NDR, not anymore. I think they're fully remote now. But back in the day when I was there, there was an office. It was at a little strip center in Venice, Florida. So it's totally nondescript. Like you drive right by it, you wouldn't know what it is. But there's 120 people working at a real deal Wall Street finance, off Wall Street, I guess, research shop. And in that, and so he basically controlled an entire strip center, and that's where we worked. And in that was a gym. So like you said, I like to work out, and so did Ned. Obviously, Ned liked to work out because he put a big gym in there, and so we would be in the gym working out together all the time. And I got to know him. I got to know his right hand guy, Lauren. Shout out to Lauren, really well, and learned a lot from them. And mostly like the way to build charts, the way to visualize data. I borrowed a lot of the concepts I learned there and brought it over to 314. And Ned always just had these great phrases. One of the ones that stuck with me, and something we've kind of talked about here, is that this is a mistake business. The winners make small mistakes, the losers make big mistakes. But it is a mistake business. We're just making mistakes over and over and over, and you want to minimize them. And to me, that's how we build everything at our shop now at this point in time. And it's like those broad truisms, you have to build them in and implement them. And that's really, I think, where the magic happens. So, but yeah, he's an awesome guy. And,
well, just hearing that's great because, I mean, in this industry, we all know someone, and sometimes you leave and do your own thing and the divorce gets a little messy, but to hear that, you left on good terms and then things went well, that's awesome for both fronts. I think it says a lot for NDR. And again, just huge fans of NDR. Sonu, again, with about 10 minutes to go, what else should we talk about?
Luckily, we have only 10 minutes because we could probably spend 3
we
hours
could go forever.
on this.
Yeah, I know.
That's why I was like pushing it to the end, because otherwise it would just take over the whole thing. You know what I'm probably going to bring up? Tariffs, right? But let's put it in the context of, Warren, your target for the S&P 500. I know targets are like whatever, like everyone needs to put a target out with an outlook, but it's really, I look at it as what's the process that got you to the target? Right. And you kind of already described that with the search for neutral, all of that. But talk about tariffs, and maybe start with this. Do we take Trump literally or seriously, or both?
Oh my, that's like that's the toughest one.
That's a tough one.
To me, I'm honestly,
I have my own thoughts, but you go ahead.
I'll be interested to hear what you think. But like, to me, when we designed our target, I basically said, I'm not going to try to triangulate policy in advance. And I'm almost still at that place where I just don't know how much of a payoff there is for me to try to back into exactly what's going to happen and then when it's going to happen and then all these things. Like, I'm much more about taking what comes and reacting to it. Now, the move we did make back in early February, maybe early mid-February, was we took our equity exposure down. So we were running an overweight, recommended overweight, and we neutralized that. And that was following, the first tariff threat. If you remember that over the weekend, and markets kind of read. Then we came back and the market rallied, and we said, look, I don't like what's going on here. And it's not even so much about tariffs, because like I said, I don't really know how that's going to break. But what I do feel happening is the Federal Reserve is becoming more what we're calling recalcitrant or combative. And so the Fed is now going from this proactive stance last year, which we thought was really important, to the soft landing, to dragging its heels. So in my view, we're going to have this pain. That brings in this growth scare. It brings in this period. We thought we'd have a 10% plus correction in the first half of the year. And we thought that the late Q1, early Q2 was a good spot for that. The other factor I bring into that timing analysis is that whenever you have a huge bull market year, the year before, there's a liquidity drain that happens in the market where you start seeing basically
pay taxes on that.
People have to pay taxes, especially think about last year. We had crypto up doubling, right? And so you have a lot of these types of traders who might have a bigger tax bill than they expect. That can have a negative real economic impact that can flow into markets. If you study those years, you tend to get little dips there. It's not science, but there is some evidence that suggests that. So when I line that up with the recalcitrant Fed meeting a little bit later this month, the volatility of tariffs, we were just like, we want to neutralize our equity exposure, probably get a better chance to buy and get back overweight, because we still do have a bullish outlook for the year, get back overweight as we move through this period, probably sometime in April. So the biggest issue I see with tariffs, the bottom line that is how it impacts the Fed's reaction function. I think it makes the Fed less likely to cut at the first whiff of weakness because they have this tariff calculus they're doing.
It's funny. I've had several calls this week. We did one with Ryan as well, and earlier we do one every Monday morning. I did one with another colleague, Barry, yesterday morning for our advisors, and that's been our theme as well. Like I said, I find myself agreeing with you almost too much, baby, because you always want to say, what am I missing, right? Especially from smart people like yourself, like, okay, maybe they're doing something different than what we are. But yeah, no, I've always said, I don't know what it's going to do to what tariffs will do to inflation, what tariffs will come into place. With respect to Trump, I think he likes tariffs. I mean, whatever justification, rationalization people around him put for tariffs, I think Trump has liked tariffs since the 1970s, 80s. He wants tariffs. I mean, so I just wish we'd just get it over with. But that's wish casting by myself as opposed to who knows, right? But tariffs are always a threat. It wasn't like this is a surprise. But we've been in the camp that what we do know is that it pushes the Fed to pause for longer, right? Even as rates are meaningfully restrictive.
Yeah, that was one of the things. Now again, not to get too technical, but you go back to 2018, the first round of tariffs. And the Fed staff prepares a teal book, which is kind of just their internal document, their internal studies for the Fed. And that doesn't come out right away. It comes out 5 years later. And so in that teal book, they did some basic analysis where they said, if you do tariffs, our studies, and when we game this out, suggest actually you should cut rates and look through the potential temporary inflation they cause. And I think that created a lot of complacency as you came into the year where people were like, hey, the teal book, remember the teal book, it says the Fed's going to look through the tariffs. And now you're seeing the Fed say, well, remember you go back and read the actual teal book. What it says is that if inflation expectations are anchored, then you look through that. And I think that's why there's so much focus now on the UMISH inflation expectations going up, because they're saying, look, this changes the landscape that we're in. And so now we're not going to cut in the face of tariffs, we're going to hold. So those are subtleties, but I think they make a lot of they're going to make a big difference as we move through this period of time.
The expectations, that's a great point there. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback, and please send any emails to facts versus feelings, versus is VS at carsongroup.com. That's a great point. When the tariff started February 4th of 2018, the S&P was up on a total return basis 15 months in a row, an all-time record, 15 months in a row. The stock market was up. Then tariff started. We had volatility. But something I think people forget is, okay, they look at 2018 and they see the stock market down, I don't know, 4, 5, 6%. So, oh, tariffs weren't good. And I don't know, but then you remember it was a Fed policy potential mistake in December of 2018 when the market threw that big fit, almost a bear market in like a week. Then the Fed changed their tune a little bit. I mean, that's one thing that's swirling in my head because everybody's worked up over tariffs, maybe rightfully so. But our big theme also, Warren, is the Fed, with productivity still strong, we've been saying they should have been cutting the whole time to relieve, again, some of the concepts we talked about earlier with housing and maybe small businesses and some of those things. And again, I know we're at the end. We don't need to open up a whole new jar, but when do you think the first Fed cut will come?
Yeah, my best guess would be May.
Okay.
I'm with you. So last year, one of the things we said was that the Fed was way too eager to look through shelter inflation. Jay Powell's been going to Congress and saying shelter inflation's on the verge of rolling over. Shelter inflation's on the verge of rolling over. We did a lot of work on that. But now, from what we can tell, measured shelter inflation is truly on the verge of rolling over. So I think you're going to have a stair step lower in CPI. And so that to me, when, again, going back to the oil discussion a bit, there's three broad vectors of inflation that I see. There's oil, there's shelter, and there's the job market. And I don't think any of those are going to cause inflation pressure this year. So as long as the growth backdrop remains intact, I think the Fed's going to be cutting. Our view is the Fed's going to cut 4 times this year. Okay. We've had that view throughout the year, even when everybody was saying no cuts or potential hikes. And I think when we get to the end of this year, to tie it all together with that discovery neutral, it's going to be a massive shift in the economic sentiment that we see going through this year. You came into the year higher for longer, maybe neutral is 4%, terminal rates 4%. I think we're going to end the year in the big stories being printed out in the financial media is going to sound more like, hey, maybe neutral never changed. Maybe the pandemic and all this debt, it didn't even do anything to the economy. And we're stuck with the same economy, same demographics, all that. The truth is probably a little bit in between the two narratives, But the key is going to be able to play those narratives and to play them in the markets as they evolve.
Wow. One more for you, Sonu, then one more for me, and we probably have to wrap it up.
Let's take it, use that as a tangent itself. How important is understanding what the market narrative is, especially to the work you do, versus creating your own narrative, in your case with data and modeling, right? And, maybe connect that to, again, the ETFs you manage and the work you do.
Yeah, I think that if you can see a mispricing, or if you can see an area where the best thing you can do as a researcher, or even I'd say a PM, is to look for areas where you have a strong conviction that the market's not seeing. Mm-hmm. And so I'll get louder on Twitter at different points in time, because
I've seen that.
Okay.
Even with the higher for longer people.
Yeah. Well, I thought the higher for longer, I thought the higher for longer crowd was, I saw a major difference between us, and I honestly, when people are throwing arrows at you on social media, that's a good sign. I want to have a view that people are making fun of, and that people come at me, because ultimately it tells me that I'm over here and the market's going to come to me if I did the work right. And so I think it's a really important aspect. Is now, when you're in bull markets, I think you can be to be totally honest, I think you can be a little bit easier on that, because it's just the natural path of the market and assets. Mm-hmm. So markets go up, but once you start getting into these areas where there's some stress in the market and some major changes in cross markets, that's where the narrative's shifting, and you need to really tune in to what's happening, and then what's reality, what's the data really saying. So we're going to go through one of those periods right now where I expect the recession. We went through no recession complacency, and now we're going to go to recession is going to be the big thing. We're talking growth scare right now. Right. Stagflation, recession. Yep. Who knows? We're going to have some residual seasonality in the CPI. All these things are going to throw off that financial media narrative. And so I think it's important for us to stay tethered to the data over this period of time, and flexible, because I could be wrong. So, I'm ready.
That's where the PM hat comes in. You say you don't want to make big mistakes.
Exactly. Yeah, that's the key. If you're going to make a mistake, make a small mistake, and just accept that that's part of the game. It's part of the game we're playing.
Yeah. We've been fairly optimistic and remain there, overweight equities, but we've added some treasuries this year. Even late last year, we added some treasuries. And similar to what you're saying, this time 3 weeks ago, we were being told by really smart people there might be hikes this year, only one cut. We were pushing back against that also. Wasn't always popular, but now here we are with the market looking for 3 cuts almost, I think. And like you said, maybe even a little bit more. But Warren, this is kind of the end of the road of episode 126 of Carson's Facts versus Feelings. I want to give you one more opportunity or chance to promote yourself, promote your company. Tell us how you potentially can help financial advisors. We'll be very clear. Sonu and I are not recommending anything you're about to say. Obviously, we're fans, but we live in a world of compliance, so I just have to give that disclosure. But promote away, Warren.
Wow, I'm not a very good self-promotional person. The best way I think our work is we have a lot of financial advisors, hedge funds, family offices as clients. That's really our bread and butter. We offer models and research and analytics that I think are valuable and independent and objective. And so the best way to see it is to get in touch with me on our company website, and we'll send you some sample research. I think once you see the research, you can tell. My personal belief, wouldn't start the company if I didn't feel this, is I just don't see anyone doing it better than us. Mm-hmm. And so that's my as humble as you can say something like that. That's my humble opinion. Wow. So,
and what is the website?
3, 14 spelled out, FOURTEEN.com. It's our marketing site. You get a little information. There's some free research on that. But if you put your name in the form, one of my colleagues will get back to you and then see if you're a good fit as a client.
And the password for a free trial is Sonu, I believe. Is that true? I've used that joke before. Anyway, no, we'll have in the show notes, obviously a link there, but obviously, Warren, you're out there on social media and different places. So listen, we really appreciate you jumping on with us, talking about St. Paddy's Day, pies, Pie Day, the Fed, all types of fun stuff. Hopefully you enjoyed this. We're big fans. And, well, like Sonu said, I kind of knew your views, but we see a lot of this stuff eye to eye. So let's hope
the only
we're all said and done.
You're expecting 4 cuts. We are expecting 3 cuts. So
Yeah.
Well, I'll see it over where I'm at soon.
Yeah.
No, but once my views change, have me back and we can argue a little bit.
There we go. All right. Well, thank you, Warren, and thank you to all the listeners out there. Again, give us a review, do those things to help us with those algorithms. Goes a long way. And again, everyone enjoys, have a safe St. Patty's Day by the time you listen to this, and have a safe Pie Day, and eat a pie to celebrate, and check out Warren Pie's amazing research. With all that, everyone, we'll see you next week. Take care. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.